Thank you, sir. Yes, Jedi Options, Iron Condors. Let me just echo one or two things Matt said in the lead in. The reason why this is so attractive right now is because a lot of people don't have a strong bullish opinion because the short term technicals aren't great. But because we've already pulled back a decent amount, they may not also have a strong bearish opinion. And if you're just a directional trader, you're kind of at a loss right now. We're like, I don't feel the need to press my bearish bets, at least not today. But nor do I really feel the need to bottom fish here because the market's not giving me really a reason to go bullish directional. I'm sympathetic to directional traders in an environment like this because if you don't have an alternative, you're just relegated to kind of sitting on the sidelines and twiddling your thumbs. And so I'm presenting to you an alternative, you directional traders. If you want to get into the world of cash flow, where you have a higher probability, where you have a bigger margin of error, where it's not as much a directional bet as much as it is just a bet on time. The Iron Condor is kind of the quintessential cash flow trade that's non-directional, right? Because there are bull puts, but they're slightly bullish. There are bear calls, but they're slightly bearish. You can sell naked puts, but they're slightly bullish. What if I just want to be straight neutral? Straight neutral. Like you could see right now in the S&P, someone being of the opinion that market's not going to go up that much over the next month because I think interest rates and inflation put a cap on it. But given the work we've done since October and how far along we are in the interest rate hike cycle, maybe I don't think there's any major downside coming. So I think there's kind of a theoretical floor down here somewhere. And in light of where we're sitting today relative to the cap and the floor, I think maybe we're kind of in the middle. We're kind of in the middle. So it's not so much that I'm betting the market's going to go dead sideways. It's more that I think that weakness at a certain point gets bought and we're not going to completely implode. And simultaneously, strength may get sold into, or we're going to have a trouble like getting a sustainable uptrend because of the inflation and interest rate concerns. And so I could map out like some potential paths here for the market where we go sideways, or maybe short-term weakness, but it's bought eventually, or short-term strength, but it's sold. That is a mean reversion type of market. Mean reversion just means you think we're kind of at the average price for the next month. You think strength gets sold. You think weakness gets bought. If the price goes up and then comes back down, or goes down and then comes back up, that is by definition a mean reverting movement, right? Or mean reversion, as we say. So how do I bet on that? Like, again, the directional stuff I think is a little bit tricky, but how about I just make that bet? How about I just bet the market's going to be somewhat in a range for the next month and call it good? Well, that's what an Iron Condor does. Essentially, what you're going to do is you're going to sell puts below the floor. You're going to sell calls above the ceiling. And then you hope that you stay between the two, and the puts expire and you keep the credit you got paid, and the calls expire and you keep the credit you got paid. And it's all good. And it's all good. So structurally, when I say you're selling calls above resistance, you're going to do it in the fashion of a bear call spread. Because you could sell just calls and you could sell just puts, a naked call, a naked put. That would be a short strangle, and the risk is open-ended, right? It's a legit idea. We're sticking with a limited risk path here today. The bear call is a limited risk way of selling upside calls, okay? The bull put is a limited risk way of selling downside puts. So that is the structure of the Iron Condor. So I may come in here and I may say, well, gee, I think the S&P is going to stay below 425. So let's sell a 425, 430 bear call spread. Maybe I get paid 50 cents. Okay. Fast forward to expiration. As long as we're below 425, I keep the 50 cents. Right? I'm bearish enough to bet we're not going to get above 425. But I'm also bullish enough to bet we're not going to get below 365. So why don't I sell a 365 put and buy a 360 put? That's a bull put spread. I'll get paid 50 cents credit. And if we fast forward to expiration, as long as the S&P is not below 365, I get to keep the 50 cents, right? So S&P, do whatevs. Just don't go above 425 and don't go below 365. Let me keep my dollar credit I got for the both of those spreads. And then we're all happy. We're all happy. Effectively, that's what you're doing if you put in a condor here. Now the question then is, well, all right, that's the general concept. Well, what strikes? What kind of credit you looking for? What are your guidelines? I'll give you just a couple. If you're going to use maybe 1 to 2 month options. Some people really like the 30-day time frame. I don't mind 45, 50 days myself. So shorter term to take advantage of time decay. And usually you're selling lower delta options if you want a high probability of profit. Okay. And so maybe delta, maybe less than 20. If you get down to 15 or 10, if you really want to go high probability. For me, I just want an ROI that's around like 15%. My threshold, if I just do a bull put, is 10%, or if I just do a bear call, 10% is kind of the lower threshold. Because I'm doing both, I want paid more for my troubles. And so it shouldn't be hard to get a little bit higher return on a condor versus just a credit spread, because the way the cost structure works, they don't charge you money on both sides. So those are some of the guidelines that I like for an Iron Condor. Let me build one real quick as the final thought here. So if I go to the S&P, I'm March monthlies are 13 days out. Forget that. Way too close. I'm going to go out to the April monthlies, which are 51 days out. It's going to give me some room. And what I tend to do is I'll focus on the delta column, and I need more strikes here. Let's start with a delta maybe around 15. So what if I sold the 363 put, and then I do a $5 wide spread. So I'll buy 358, I get 56 cents. That's fine. And then I'm going to go to the other side, because you want the kind of balance. Don't sell a bull put for 56 cents and then a bear call for 10 cents. That's dumb. You want it to be somewhat balanced, because you have a balanced neutral bias. So you want equal or similar credit on each side. And it should be about a similar delta too. So I'm going to go to the 15 delta on the call side, build me a bear call spread. Now that one gives me 74 cents, which is actually more than I need. I'm noticing that the strikes get a little wacky above 420. It's going to be hard for me to build a $5 spread. So I might need to switch up and do like a $4 wide, which I don't want to take the time to do. 74 cents is more than I need. Like I would probably bump this up to 422, 426, something like that. And then maybe switch the bull put to be $4 wide as well. So let's do that quickly here. Boom. It doesn't have a 359. All right. It's going to force my hand. I'm a little bit unbalanced here, but I think it's good enough. So I'm getting about 50 cents per side. I'm 422 and 363. And if I go look at the chart, that's pretty close to where I drew my original lines. So I'm 422 and 363, right? Something like that. I'm getting over a buck, which is actually about a 20% return. And I'm essentially betting again that we're not going to be below 363. And we're not going to get above 422. I will actually tell you, I'd be more concerned about the 422 myself. But that is the range that the market will give you if you want a 20% return on a neutral cash flow trade. And that is an example of what an Iron Condor looks like when you build it. Now, I built the bull put and the bear call separately. The reason I do that is I want to make sure I'm getting similar credits and I'm balanced. Once you know that that's the case, you can go back and smush them together. And so you just hold control when you're building the bear call, and it'll add it to the bull put. And here you'll see now it turns it into a condor. And I got a $1.09 credit, right? Which I think is great. We'll leave it at that for now. But that is the type of strategy when you hear us talking about cash flow, high probability, big profit range, play the time decay, patience plays, all those kind of things work towards this type of structure. And it's worked for the last month. The market's kind of exhibited mean reversion because of this pullback. It got a little too hot, and then it cooled off. If you think that continues, this is a legit trade structure.